Hello everyone, I'm James Hart and welcome to this Orbex trader education session where we're going to discuss what is perhaps one of the simplest yet most effective aspects of technical analysis, and that is support and resistance. Now, many new traders discard support and resistance, or probably a better description is that they fail to understand the power of what it is. They discard it as simply drawing lines on a chart and then hoping to see a price reaction. But to think of support and resistance in these terms only is to misunderstand what support and resistance is and why these levels can be so useful. So in this session, we're going to talk about the underlying order flow dynamic that creates support and resistance, how to properly identify these levels, and then we'll talk about ways that we can actually use these levels to highlight trading opportunities, as well as looking at some tools that we can use to help us in our support and resistance trading. Now, as ever, if you have any questions during the session, please just write them in the chat function and I'll stop periodically as we go along to answer them. Okay, so let's jump in then and kick off with, first of all, what is support and resistance? So when we're talking about support and resistance, we're talking about levels in the market that actually give us some insight into the underlying order flow. So support levels tell us where there has been demand in the market previously and where we can anticipate that demand remains, and resistance tells us where there has been supply in the market and where we can anticipate that supply remains. And really, that is all this boils down to. So it's just a game of supply and demand, with price being driven by underlying orders. So support and resistance levels help us to identify areas where we can potentially get involved, looking to buy price where there is good demand and looking to sell price where there is good supply. So that's what these levels are. Support and resistance levels are simply levels in the market that identify supply and demand. So let's take a look at an example then, and I'll walk you through this concept more clearly. Okay, so you can see here then, we've got our two sets of levels identified. We've got our resistance levels overhead and we've got our support levels below. So looking at resistance first of all then, resistance is simply where there is a buildup of orders to sell, creating supply in the market, and this is where price is typically capped as it moves higher. Okay, so as price is moving higher, it runs into this supply, into this buildup of orders to sell, and price moves lower from that level. Similarly, demand, which you can see highlighted here at the bottom, the support level. Support levels are simply an area where we have a buildup of demand, so a buildup of orders to buy. And what we typically find with support levels is that as price trades down into those levels, price meets that buildup of orders to buy, meets this level of demand, and then price bounces and moves higher. Okay, so this is the underlying order flow dynamic, which is creating support and resistance. So support and resistance levels, when they're highlighted properly, aren't just random lines drawn on a chart. They're levels that act as a visual representation, visual reminder of the underlying order flow dynamic that is driving price action. So supply and demand. So looking at this example then, and thinking about these levels in those terms, let's sort of trace a narrative of what was happening with price during the course of this period. So you can see, to start off with, we had this really heavy sustained sell-off in price. We've got a long row of consecutive bearish candles telling us there was heavy selling pressure in the market. So price trades down to this point here before we see buyers step in and turn price higher. Now you can see that price tested this area subsequently 2 more times before eventually reversing and trading all the way back up to this point here. Now we traded up to this high point, and you can see that we traded up to this high point on an explosive bullish candle, a very large bullish candle, no doubt in response to a big news event. So price trades up to this high point here, and then once again you can see that we reverse sharply lower. So we reverse sharply lower from this point because there is a buildup of supply in the market. Okay, and you can see that this buildup of supply is strong enough that on each subsequent test of this zone, price was eventually turned lower, trading all the way back down here. So at this point now, we know two things about the market, okay? We know that we have a strong buildup of demand in this zone here, where we've put in our two red horizontal lines, giving us our support zone. And we know that we have a strong buildup of supply at this level in the market here, where we've highlighted our two horizontal lines, giving us our resistance levels, okay? So we know that buyers are strong at this point here, and sellers are strong at this point here. So now if we look at what happens then as price continues from this level. So we reverse from our resistance level here, we trade all the way down to this point here. Once again, we test that demand zone, so we test our support level, and you can see that buyers step back in again, taking price all the way back up in this nice, sustained bullish run. And where do we go? We go all the way back up to the resistance level, where price stalls out, as sellers step in, driving price lower again, okay? So you can see the pattern of the behavior that we're seeing from price action here. And from that high point there, where do we go? We trade all the way back down into that support zone once again before reversing and trading higher. Okay, so essentially what we're doing here is mapping the moves that we're seeing in price action and building an understanding of what is driving price. And at the point that we see these first reversals higher from here and we see these first reversals lower from here, we know two things, okay? So to reiterate what I was saying a few minutes ago, we know that we have a buildup of orders to sell, which we call supply, creating resistance in this region here between these two red horizontal lines that we have drawn on the charts ourselves. Similarly, we know to the downside that we have a buildup of orders to buy, creating demand, which is creating support for the market between these two red horizontal lines, which again we have put in ourselves. So at the point that we've identified this resistance level and this support level, we're simply watching price action as it continues to oscillate between these two levels. And you can see that from first identifying our demand here and first identifying our resistance here, we get two subsequent tests of each side of that range, okay? So when you hear traders or analysts talking about ranges, what we're simply referring to is the area between a resistance and a support level, okay? So a range is denoted by price oscillating between the low point and the high point, as we have here. So what we typically see then, as these levels start to make themselves known, is that speculative players start to join in and reinforce this dynamic. So as price trades up into this resistance level, speculative players can see that we have a resistance level in play and the supply is taking price lower, and so they tend to join the market, scalping and initiating short positions as price trades into that resistance level. And then the same thing is true of the downside. As price trades down into these demand levels, into these support levels below price, below the market rather, this is where we get buyers stepping in, initiating long positions, hoping to profit, hoping to benefit from a reversal higher. So hopefully by now you've got a clearer picture of what support and resistance is and how it can be helpful in terms of allowing us to analyze the market and make trading decisions. Now it's important at this stage to highlight, you'll see that I've drawn two sets of lines for each resistance and support level. And the reason that I do this is that I prefer to think of support and resistance as zones rather than specific levels. And I've always found this much more useful for my own trading and analysis. So when I'm doing this, what I'm looking to do is take the highest levels, the two highest points to identify resistance, and the two lowest points to identify support. So for example, with this resistance level here, you can see that my high line is the top of this bullish candle wick, and the low line is the close of that bullish candle. And then you can see each time the price is traded up into that zone. Now to the downside, my support level is the two candle lows that we have here, and then this final candle low here, okay? So this range is determined by price oscillating between the support and resistance levels. And the reason that I use two lines rather to identify zones rather than specific levels is that although you will find price reversing sometimes from these specific levels, using two lines to create a zone. So in essence, creating a sort of minimum threshold for the level and an upper or lower limit is far more useful, because you tend to find that price action can be quite volatile around these levels. So we get a sharp change in order flow as price is trading into support and resistance, and this can often create a lot of volatility. So using two sets of lines instead of one specific line can give you a little bit of room and a little bit of leeway. And later on, when we talk about how we use support and resistance for trading, I'll explain how using these two lines can be helpful in giving you clear trade management levels. Now, it's worth noting that the situation that we're looking at so far is a classic range situation. So we've identified a resistance level, our high price, we've identified our support level, our low price, with price oscillating between these levels. And these scenarios are quite simple to identify once you've spent some time looking through the charts, practicing highlighting these levels. But it's also very important to consider what is perhaps the most important aspect of support and resistance trading. And it's something which will really help you when it comes to live analysis and live trading execution. And that is the changing nature of these levels. So again, this goes back now to the underlying order flow dynamic, which we talked about at the start, which creates support and resistance. So previously, where we've identified that orders to buy create demand, which creates support, and orders to sell creates supply, which creates resistance. Well, once one of these areas is broken, it actually reverses its status. So once support is broken, you'll often find that it becomes resistance, and once resistance is broken, you'll often find that it becomes support. And so again, this is down to the shifting underlying order flow dynamic, which is driving price action and underpinning these levels. So let's look at a chart example of this then, and again, I'll walk you through this concept. So, okay, you can see here then, in this scenario, we are imagining we're at this point in time, okay? So we've identified our range. So we've got our clear support level at the bottom here, where we've seen price bouncing, where we know that buyers are strong. We've then got our clear resistance level here, where we've got our buildup of supply, and we know that sellers are strong here. You can see each time price has tested this level, sellers have turned price lower. However, at this point here, you can see price explodes up through that upper limit. So it explodes higher through our resistance level, and we go on to trade much higher indeed, all the way up to this point here. So almost double the size of the initial range above that resistance level. Now, from this point here, we get a very sharp, very sustained sell-off. Price trades all the way back down and retest that resistance level. But now look what happens. This is the interesting point. Look what happens as price tests that resistance level. You can see that we actually stall, reverse sharply, and then go on to trade higher. So why is that? What is happening to create that reaction at that prior resistance level? So the reason is simple. So if we think about why this level breaks and what has to happen in terms of order flow for that level to break. So we know that we have good supply at this level. We know that we have sellers capping price. So each time price has traded up to this level, sellers have stepped in strongly and taken price back down. So we know that we have strong supply. However, at the point that price breaks through this level, we know that demand has overwhelmed supply. So we know that buyers have outstripped the strength of sellers and taken price higher. So we now know that at this level, where there was previously good supply, there is now good demand. And so once price is above that level, once price trades back down into it, we're now looking at that level as being a strong level of demand instead of a strong level of supply. So when price was below that level previously, so at this point in time here, when we were in the range, price was chopping around, we know that we can expect price to trade lower from a test of that resistance level, because we know we have a good buildup of supply. However, once price is broken out above that resistance level, we know that there is stronger demand in the market around that region than there is supply. And so once price comes back down to test that level, we can then anticipate that this demand is going to create support and hold price up. And that's exactly what you can see here. And indeed, if we just focus on this bearish candle, this large bearish candle, which was the candle that formed as price actually tested the level, you can see a good indication of the strength of that demand in the market, because look how strong the very initial reaction was at that level. So this candle traded down into the support zone, pierced it before reversing sharply higher to close all the way back up at highs here. Okay, so this changing nature then, as I say, is one of the most important aspects of support and resistance, and creates two sets of conditions. It creates both the range conditions, where we see price oscillating between support and resistance, and it creates the retest conditions, whereby price breaks a resistance level, retests it, and acts as support. And oftentimes what we'll find, vice versa, once price breaks down through a support level, when it trades back up and retests the underside of that support level can act as resistance, pushing price lower. Okay, so we've now looked at what support and resistance is. We've talked in detail about the underlying order flow dynamic that creates support and resistance. And we've also looked at the changing nature of support and resistance, and talked about the two specific scenarios or sets of conditions in which we can use support and resistance. So going back to our first example then. So what we saw here then, as we said, it's a classic range situation whereby price is simply rotating higher and lower between these two levels. So when the market is in a clear range bound scenario, as we see here, the most basic trading method which we can look to adopt is simply where we look to fade the range. So we look to adopt a mean reversal strategy. And this simply refers to a situation whereby we sell as price trades up into resistance, anticipating the price is going to trade lower, and we buy as price trades down into the support, anticipating the price is going to trade higher. Okay, so it's a very simple, very straightforward way of approaching the market, and it's one that is favored by a lot of traders, okay, specifically because of how simple it is to adopt and to use. So we identify our support and resistance levels, and then as price trades into support, we're looking to buy, taking price all the way back up into resistance, and then vice versa. From these resistance levels, we're looking to sell, holding our trade down into the other side of the market. Now, in terms of how we actually execute trades in this manner, we have two options. So the first is we can simply look to either buy or sell a test of the first level, okay? So you can see here again where I've identified two sets of lines for each support and resistance. If we're looking at the resistance level, we can either look to trade a level test whereby we sell as price test that first resistance level and put our stop above the second resistance level. Similarly, once price trades down into support, we can look to buy as price tests that first support level with a stop below that second support level. But the thing about this is it's a simply more aggressive way of trading, okay, because we aren't actually waiting for any confirmation here. We're not allowing the market to sort of tip its hand and show us where it's going. Instead, we're simply anticipating a reversal and taking quite a premature move. So although many traders do adopt this approach, it's not an approach that I tend to use myself. And the approach that I prefer is to wait for price action confirmation. And for those of you who have been in my other sessions, you'll know that price action confirmation is something I talk about a lot, and it's something that I use a lot in my own trading. And this is where we simply wait to identify a reaction in the candlesticks at our preferred trade location in order to go ahead and place our trade. So let's take a look at an example of this then, and again, I'll talk you through this concept. Okay, so in this example here, then, you can see, again, we've got our support and resistance levels clearly identified, okay? So we've got these two big touches to the downside here, three big touches to the top side. So this is a really strong range that we've got in the market. Now, we're watching price as it goes along, and we're looking for periods of price action at our support and resistance levels. So you can see highlighted here in this box, we've actually got a really good example of this exact price action confirmation. So as I say, so imagine we're at this point in time then. We've highlighted our resistance levels, we've highlighted our support levels. We can see price trading down to this support level here. We know that we've got two previous big reactions at this level. We know that there's a lot of demand, that buyers are stepping in strongly, pushing price higher. And so as price trades down into this level, we're waiting to see how price action reacts to see if we get any sort of buy signal. Now you can see in the box that I've highlighted, we've got exactly that signal indeed. So the first candle to touch the support level then is this small bearish candle here. The second candle that we see form, you can actually see we form this large bullish engulfing candle. Okay, so for those of you who are familiar with candlestick reading, or for those of you who are in the candlestick reading sessions that we've done, you'll know that engulfing candles are a really strong reversal signal. And essentially they're formed where the range of the outside candle completely encompasses the range of the prior candle. So you can see that this candle is much bigger than the candle before it, okay? So this identifies a really acute shift in sentiment. And essentially, at the point that we've identified this large bullish engulfing candle at this support level, we have confirmation to go ahead and place our buy trade, okay? Because we've got confluence between two signals. We've got confluence between our bullish engulfing candle, which we know is a strong bullish reversal signal, at the point, or at the site rather, of this strong support level where we know there is a buildup of orders to buy. So essentially think of it as getting a green light on placing our trade. We've identified the location at which we'd like to place a trade, which is looking to trade a reversal higher from a test of the support zone. And then we've identified a strong bullish reversal signal at that precise location. So the confluence of these two technical elements gives us the go ahead to place our trade. Now, typically, range scenarios, as we've looked at during the course of this webinar so far, tend to form during periods of consolidation in trends or at the end of a trend before the trend reverses. So these scenarios are what we refer to as mean reversion, where price is simply extending in one direction before reversing and trading back in the other direction, okay? And so if you take the average of price over the course of the range, the mean of price is going to be somewhere around the middle, okay? So this is what we mean by mean reversion. Price isn't making any directional moves. We aren't trading progressively higher or progressively lower. Price is simply trading in one direction, reversing, trading back in the other, and then reversing, okay? So it's just oscillating around in this wave situation. Now, when price is trading in these conditions, in a range situation, we can also look to use technical indicators to help strengthen our bias for taking a trade, looking for confluence between overstretched momentum readings and key support and resistance levels. This can be a really great way to capture strong reversals. And for the more conservative traders among you, or for the traders who are still building their confidence in placing trades, looking to build in extra criteria like this is a really great way to improve your chances of success. Now, one such indicator which I find particularly useful when trading in this manner is the RSI indicator, the relative strength index, which identifies momentum in the market as either overbought or oversold. So if we take a look at this exact example then, but this time with the RSI indicator turned on, so you can see the RSI indicator, this blue oscillating line between these two thresholds down here. So the RSI indicator then is simply measuring the strength of price moves, and once the indicator moves up to this upper threshold, it's identifying momentum as overbought and vulnerable to a reversal lower. And when the indicator moves down to this lower threshold, it's identifying momentum as oversold and vulnerable to a reversal higher. So interestingly then, if we look at what the indicator was telling us at the point the price tested that support level and where we got a big bullish engulfing candle, you can see that the indicator had moved down to that lower threshold. So now we have confluence between three technical elements, okay? So we have a big bullish engulfing candle giving us a strong buy signal at the site of a well-defined support level, and we've also got the RSI indicator down at the lower threshold telling us that momentum is overstretched to the downside, oversold, and vulnerable to a reversal higher. So once we identify the confluence of these technical elements, we know that we have a strong case for entering a buy trade. And as you can see from the top of that bullish engulfing candle, price trades strongly higher. So this would have been a really nice trade to take. Now, hopefully what you're seeing here is this sort of process in which you need to approach trading support and resistance if you're looking to trade in this manner. So really all we're ever doing with these trading strategies and these different trading methods which we outline in these sessions is looking to help you understand the process behind taking these trades, okay? Because I know that for some of you, when you pull up these charts or when we talk in these sessions and you see all of these different technical elements, it can be a bit daunting, but really it is sort of like following steps up a staircase. It really is very simple. So the first piece of the puzzle is identifying the support and resistance levels. The second piece of the puzzle is identifying what is going on with price as it tests these levels. So in this example, we've identified our support level here. Price has traded down into support. We're looking to see what is happening. You can see price has formed a big bullish engulfing candle, giving us a strong buy signal. We then pull up our momentum indicator, our RSI indicator, to see what it is telling us about the market. And you can see that this acts as a final point of confirmation, telling us that bearish momentum is overextended and price is vulnerable to a reversal higher. So this is a very straightforward process that you can apply over and over again. It doesn't matter what time frame you're trading, if you're trading the 15-minute or the weekly chart. It doesn't matter which instrument you're trading. If you're trading equity indexes, commodities, if you're trading the currencies, it's all the same, okay? This is just a very straightforward process you can apply over and over. Okay, so we've just looked then at the trading confluence between technical indicators, price action, and the momentum indicator. Now, another way in which we can look to trade support and resistance is looking to trade retests of the broken levels, okay? So far we've been looking at trading price in terms of fading it as it trades into these support and resistance levels. So looking to sell as price test resistance, looking to buy as price test support. But again, what we need to think about is that other element of support and resistance, which we talked about earlier, which is the changing nature of these levels. And this can also be this can also be an element that we can exploit really well for our own trading benefit. So as we discussed, once support is broken, it has a tendency to act as resistance once retested, and once resistance is retested, it can often act as support. So let's take a look at this example and talk through this a bit more clearly. Okay, so here you go then. You can see this example, we've got a really clearly well-defined support level. So we've got these two big price lows here. Price has traded down into these support levels. We've seen really sharp reactions taking price all the way back up. So this period of price action is formed over a long period of time. So we're on the 30-minute charts. This is probably over a couple of days here that we've seen this level holding up. Each time price has tested it, we've had a really big reaction higher. So we know that there's strong demand in the market at this level. However, at this point here, you can see that price bounces from the level, although the reaction we get is heavily diminished, okay? So look at the initial reaction we get from price testing this level for a third time compared to the previous two tests. So these have both been really strong, sharp, acute reactions higher. This final reaction has been a heavily diminished, really shallow reaction. So this is telling us that at this point, demand is weakening at this level and the level is vulnerable to a break. And then what you can see actually happens is price breaks down through that support level, trades all the way down to this point here, and then look what happens, okay? Price trades back up. You can see we've got this very choppy, overlapping, corrective type of move higher. We trade all the way back up, retest that broken support level, and then look what happens now. This time, the level is acting as resistance. So remember, right back at the start of this webinar, I showed you price breaking above a resistance level and how that resistance level, once broken, could change to act as support. And so that's precisely what we're seeing here. So this time around, price is broken down through a strong support level in the market, traded back up to retest the level, and this time the level is holding as resistance, and from here price trades lower. So the trading method which we can adopt then in these conditions is looking to trade a retest of the level. So what this means is once price breaks down below support and trades back up to retest that support, we can look to enter a sell trade, anticipating the price is going to continue its move lower. Similarly, as we looked at earlier, once price breaks above resistance and retest that resistance, we can look to use that resistance level as support, entering a buy trade. Now, this type of trading, so this break and retest trading, can be particularly helpful in trading trending markets. So in prior examples, we were looking at price oscillating between a high and a low point, creating a trading range. But as we know, the market also tends to move in trending formation, whereby price is extending either higher or lower. Now, in these conditions, once price is trending, we don't see price oscillating between a high and a low point. We see price continuing to push in one direction. However, the structure of these trends often tends to see lots of retests of broken support and resistance levels. So again, as we can see here, price has created this large support zone, okay? We've got our high here, and now if we map this move from this high in terms of identifying this period of price action as a trend, you can see what I'm talking about. So we move from this high point down to this low point. We trade up and make a lower high. We then trade down. This level holds a support initially, but then breaks. Price trades down to here to put in a new low. Okay, so you can see this zigzag formation. Now from this new low, price trades back up to retest that previous low, which holds as resistance. Price forms a lower high and then trades down to form a new low. So again, this is highlighting that zigzag trend formation which we tend to see. And what I'm trying to explain to you here is just how well we can exploit this structure in using these break and retest trade techniques, okay? So when price is trading lower, we simply look for price to trade back up and retest broken support levels, look for that to act as resistance to enter a sell trade, trading in line with the bearish trend. Similarly, when price is in a bullish trend and trading higher, we wait for price to break above resistance levels, retest them, and then use those levels as support to trade in line with the bullish trend. Okay, so this is a very straightforward form of trading, and as I say, it can be particularly useful when we're trading in trending markets. And again, hopefully what you'll see here is how useful it can be to highlight two lines to create a zone instead of simply identifying a precise level. Because what we're actually seeing here is as price trades back up to test this low, okay, this can be our trade entry point. So we can enter our short trade around that level, and then our stop goes above the upper level. So you can see that the two levels act as a sort of minimum threshold and an upper or lower limit. Now, once again, if we go back to using the RSI indicator in Confluence with this trading style, you can see just how useful the indicator can be. So we looked earlier at how we can use the indicator to help add extra confirmation and confluence when we're trading our range type situations, when we're looking to fade the range. But similarly, the RSI indicator can be just as useful when we're trading these break and retest style trades. So if you look at a price action, oh, I've skipped ahead here. Okay, right. So essentially, going back to this point then, so we're looking at how we can trade break and retests. So we've got our break and our retest here. Now again, there are two ways in which we can trade these levels. We can either trade these structures rather. We can either trade the level whereby we look to simply sell as price tests the support or buy as test the resistance, or we can wait for price action confirmation. So if we go back to the price action confirmation then, and look at this next example, and I'll walk you through how we can use price action confirmation in terms of trading these break and retests. So this time around, you can see we've got our resistance level highlighted. We've got our two big high points here. So we know that there are sellers in the market here taking price lower. However, at this point here, price breaks out above that upper resistance level. So we know that we now have more demand in the market than supply. Again, going back to that underlying order flow, that shifting underlying order flow dynamic we talked about. Now, once price is above this resistance, we've identified that we're in a bullish trend, okay? We've got our low point, our higher low, and our new high. So what we're looking for is price to make another higher low and give us the opportunity to get long to continue the bullish trend. So once price is broken out above this resistance level, we're waiting for price to trade back down into that resistance level, and we're looking for the level to act as support to trade higher. So if we look at what happens as price tests that level, and we'll talk about how we can use price action to act as confirmation. So again, like I say, the reason why I don't like simply trading the level is because it's a slightly too aggressive approach, which I've never really benefited from in my own trading. So you can see here, if we'd simply look to buy as price tested that first level, with our stop below the second level, this large bearish candle would have completely taken us out. So we would have been stopped out on this trade. And then, gallingly, and I'm sure this is a fate which many of you have suffered, and it's something which continues to plague all traders, you can see that just after being stopped out, price reverses and then trades in the anticipated direction. Now, if we'd been waiting for price action confirmation instead, what you can see is that we would have actually had a much better opportunity to benefit from this setup. So price trades down through the level initially. We then form a small pause candle here at the bottom, so it's slightly bigger than a doji candle. It's highlighting a contraction in momentum and indecision in the market. And then the next candle, you can see we get this large bullish candle, again giving us a large bullish engulfing candle. So from this point here, we then got our price action confirmation. So price has pierced below the support level. We form this very small indecision candle. We then form a large engulfing candle, and the engulfing candle has actually closed back above that support level. So from this point here, we've highlighted a strong reversal signal, and we can go ahead and get long with our stop down below the low of those candles. So this gives us a much better opportunity to enter our trade. And also, it's important to note that if this candle hadn't formed and price had continued to trade lower, we simply would have been out of the market, okay? We wouldn't have had a trade. We wouldn't have had a losing trade, though, is the key thing. Because if we'd just been trading a touch of the levels, so if we just bought as price traded down into that support level, we would have been stopped out, okay? So this is really the benefit of waiting for price action confirmation, and it's why it's something I've always focused on in my own trading, and it's why it's always something you'll hear me talking about so often in these sessions. Now again, finally then, let's look at how we can use Confluence with the RSI indicator to strengthen our conviction in taking these trades. So we looked at using the RSI indicator with fading the range a couple of examples ago, and now we're simply looking for the same thing. So we've identified our break of the resistance, okay? So this is this exact same chart example. We've simply zoomed out, moved forward in time, and put our RSI indicator on. So that's that last high of the resistance level. Price is broken out above it then. We've then traded back down to it, and you can see we've got that bullish engulfing candle here. Now, importantly, again, as price forms this bullish engulfing candle at the side of the support zone, we want to look at the RSI indicator to see what it is telling us about the market. And again, you can see it's giving us that confluent reading, because once again, the indicator has moved down to the lower threshold, telling us that oversold, that the bearish momentum is overextended and oversold, and price is vulnerable to a reversal higher. So at the point that we identify this confluence, so we've identified price moving in a bullish trend, price has broken out above a strong resistance point, we've traded back down to test that resistance, which we anticipate is now going to act as support. Price has pierced the level slightly. That's fine, because we know these levels can be volatile. We're waiting for price action confirmation. So we see this bullish engulfing candle set up. We then look to see what the RSI indicator is telling us, and it is giving us a confluent reading, telling us that momentum is overstretched in the market. So once again, at this point here, we've got confluence between our three technical elements, and we can go ahead and enter our buy trade. And as you can see, price moves beautifully higher. Okay, and of course it does. That's why I've used it as the example. So it's important to note this won't always be the case. Okay, these trading setups which we're looking at don't have 100% hit rates. But what we're always looking to do is improve our chances of success, okay? So this is what I'm trying to get you to understand, is the point of this process and building in these different criteria for taking these trades. So we're identifying a level. We aren't just trading the level blindly. We're looking to see what price action does as we test the level. If we get price action confirmation, e.g., if we get a buy signal at support or a sell signal at resistance, we take the trade. If we don't, we simply wait, keep our powder dry and wait for another setup. And then finally, as we get our price action confirmation, we're looking to the technical indicator, the RSI, to see if it is confirming our trade for us. Now, if you just practice these two trading scenarios, okay, so fading price when it's in range and trading breaks and retests of price when it's moving in trends, if you get really good at highlighting these conditions in the market and developing sound trade management and always using favorable risk-reward parameters, and by this I mean always looking to target more than you risk, so always looking to target a minimum of a 2-to-1 return, then you can certainly develop a way to be consistently profitable. And as I say, support and resistance formed the cornerstone of my own first consistently profitable trading. And out of many of the traders that I've worked with and known over the years, support and resistance has been at the core of many of their trading strategies too. So as I say, although it is a foundational element, it's something that's often overlooked or misunderstood by new traders, it is certainly worth spending the time developing an understanding of support and resistance, because hopefully, as you've seen today, it can be a really effective way of analyzing and trading the market. Okay, now before we wrap it up for today, are there any questions I can answer for anyone? Let me just take a look here. Okay, Valentine says, what do you say the highlighted portion of the resistance level represent? So the highlighted portions of the resistance level simply represent the two highest points of that level. So if we go back an example here, so you can see what we've got highlighted with this resistance level is the high of that resistance level, which was the high of this green candle, and the low of the level, which was the close of that candle there. Okay, so if we're looking at support, we're looking for the two lowest levels. If we're looking at resistance, we're looking for the two highest levels. So this is what I'm always looking to do. I don't use precise price levels, although oftentimes you will see price reversing in that fashion. I'm always looking to create a resistance zone and a support zone between two price points, as I find this is more useful for actually trading the market. Similarly, can we use the same principle on all time frames? Yeah, Nawaz, yeah, you can use these on all time frames. As I said earlier in the session, these are the same principles apply no matter what time frame you're using, no matter what instrument you're using. Obviously, you just need to be aware of the fact that if you're trading shorter time frames, the levels are not going to be as strong, so we're going to see a lot more noise in the market. However, same principles apply. Where you can identify clear support and resistance levels, you've got good supply and demand in the market. You can look to use these same trading principles. Typically myself, I use them on the higher time frame, but that just comes down to my own trading preference. So yeah, if you look to trade on the lower time frames, then you can certainly use these as well. What are the targets after breakouts and retests? Okay, so basically, when it comes down to trading the retests and fading, if you're looking to fade the market, you have two options. So if we go back to one of these examples, right? Okay, so if we're looking at this example here, where price has tested this support zone, okay? If you're trading the level, for example, if you're trading short here, and your stop is below this point here, then you can either look to target a minimum of 2 times your risk. So essentially, 2 times the distance between those two red lines, which would be roughly here. Or you can look to hold it until the other side of the market, okay? Because we're anticipating that price is going to continue oscillating within this range. So you have these two options. Now, similarly, with trading the retests, so we've got our retest here. So if we enter long at the retest here, which is above that bullish engulfing candle, okay? So again, sorry, you can either trade the level or the price action confirmation. So I'm just highlighting both depending on how you trade. So if you're trading the levels themselves, then you look to always trade the first level with your stop behind the second. I don't trade like that. I wait for price action confirmation. So if you're using the price action confirmation then, which you can see here, where we've got our bullish engulfing candle. I enter long at the high of the bullish engulfing candle on the break of the next candle. So I wait for price to break out above the high of that candle and I enter long, and then my stop simply goes below the low of the apex there. Now, again, I'm simply looking to target a minimum of 2 times my risk as a minimum, or monitoring conditions to see if I can hold the trade longer. Okay, so when do I expect a reversal in the trend? So reversals in the trend. So basically what I've been highlighting with these setups is where price breaks out above a resistance level, you're then looking for, so here, for example, where price breaks out above this resistance level, so we've got our 2 high points, we've got our clear resistance level in the market, where price breaks out above that high point, trades back down to retest it, that's where we're looking for price to act as support. That's where we're looking for the level to act as support, giving us an opportunity to change higher. So it's not that the trend has changed, it's that the actual nature of the level has changed, okay? So this level, which was resistance, which previously saw a buildup of sell orders, has now changed to support because we've now got strong demand in the market at that level. So once we see a level break, that's when we can then change the way that we're viewing these levels. Alejandro asks, how long do I go back to consider levels to place support and resistance? Yeah, this is a good question. This is something which a lot of people always ask. And the answer I tend to give is, really it comes down to, again, the time frame that you're trading specifically. So, you know, if you're trading on the intraday charts, you'll be looking at price action over the prior day or two. If you're trading on the daily charts, you can be looking at price action over the last few weeks. But really, what I'm always trying to do is look for levels where highs and lows line up. So regardless of how far back they go, if I have confluence between good highs and lows creating the support or resistance level, I'm happy to go ahead and use them. So I'm not really too fussed about how far back to look. All I'm looking for is these clear levels. And actually, this is a good point to end on, is to reiterate, especially if you're new to trading, when you're first identifying these levels, don't try and capture every single turn in the market, okay? So don't be flooding your charts with horizontal lines, trying to identify every possible support and resistance level. What you should do is simply wait for the levels which jump out at you and wait for support and resistance levels to make themselves clear. Firstly, because these levels will tend to have the best reactions. And secondly, because this will build your confidence and build your ability in terms of identifying these levels and trading these levels, okay? So make life easy for yourself. To start off with, wait simply to, look, you can see here, okay, we've got these 2 big resistance levels in the market. We've got these 2 big swing high levels in the market, okay? So if we're pulling up this chart, we've got no lines on it, we're saying to ourselves, where is support and where is resistance? Imagining we're at this point in time here, okay? We've got these 2 big highs. We know this is where we have resistance. Similarly, if you look at this level here, we know we've got good support. Look, we've got 1, 2, 3, 4, 5 swing lows all in the same level. So we know we have good support. These strong levels make themselves clear. What you don't want to be doing initially is getting into highlighting sort of interim levels in all the mess, okay, in between these big levels. Just stick to using the big clear levels which make themselves really obvious to you. Look to get really good at highlighting these levels and tracking these levels. What I used to do when I first started out is at the start of each week, I'd pull open my trading journal, I'd pull up my charts and I'd highlight my resistance and support levels for the week. So I'd plot these lines on each of the instruments I was trading. I'd go through the week and I'd simply jot down what was happening as price tested these levels. I'd note down the reaction. So did price bounce at my support levels? Did price bounce at my resistance levels? Did price break through the levels? If it did it then retest them? If it retested them, did they hold? Now, doing this allows you to build your capability with identifying these levels, because if you're tending to find that the reactions at your levels aren't that reliable, then the chances are you're probably identifying the wrong levels. So if you get into the habit of journaling these levels, plotting these levels at the start of each week, and if you trade on the lower time frames, plotting these levels at the start of each day and keeping a track of the reactions at these levels, then you'll start to be able to tweak your levels and find the right levels to highlight and trade. Okay, so that really is a worthwhile exercise for you, almost like giving you homework when you're at school. Okay, so if you go away, pull up the charts, highlight these big levels, and then look to track the price reactions as the week progresses. And this is a really surefire way to develop your confidence and also your ability in highlighting and trading these levels. Okay, well, look, thanks a lot, everyone, for joining me today. Thank you for all your company and contributions. This was the first live session for me after the new year, so I guess Happy New Year to you all is a fitting way to end it. I hope you have a prosperous 2019, and I look forward to many more live sessions with you over the year to come. Okay, thanks a lot, everyone. Hope you found that useful, and I'll catch you all next time. Brilliant. Thanks, everyone. Bye.